If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. As we delve into the data from the second quarter of 2025, this is the central and most urgent question facing policymakers in Westminster, business leaders in the City of London, and citizens across the entire country. The latest figures from the Office for National Statistics paint a stark and unforgiving picture. GDP grew by a mere 0.1% in Q2. This isn't just a number on a spreadsheet, it's a statistical whisper that speaks volumes about the nation's economic health, teetering precariously on the edge of contraction. This near standstill sends ripples across every corner of society. It translates into a tangible squeeze on household budgets, where stagnant wages struggle against the tide of rising living costs. It dampens business confidence, forcing companies to shelve investment plans and pause hiring, and it curtails national prosperity, limiting the funds available for vital public services. The cautious optimism that marked the beginning of the year has evaporated, replaced by tough, soul-searching questions about the economy's underlying resilience. At the heart of this slowdown lies a necessary but painful economic medicine. The high interest rates, a legacy of the Bank of England's determined fight against runaway inflation, were designed to cool demand. But now, the country is grappling with the unavoidable side effects. This monetary tightening is acting as a powerful handbrake on growth. For families and businesses, this translates into a challenging reality. Expensive borrowing makes mortgages, loans, and credit cards more costly, forcing people to spend cautiously. This consumer reticence, in turn, hits businesses' bottom lines, discouraging them from investing and expanding. It's a self-reinforcing cycle of stagnation, one that is notoriously difficult to break. This brings the United Kingdom to a critical juncture. Are these challenges merely a temporary, albeit painful hangover from the inflation fight, a cyclical downturn that will correct itself? Or do they signal something far more profound? Deep-seated structural issues, from sluggish productivity to post-Brexit trade frictions, that demand bold, transformative solutions? The UK economy is navigating a treacherous period, battling not one but 5 powerful and interconnected headwinds. This isn't a simple downturn, it's a complex convergence of factors creating a perfect storm of economic pressure felt across the country. First, the engine of the economy, GDP growth, has slowed to a crawl. A meager 0.1% expansion signals a dramatic loss of momentum. This isn't isolated but reflects a broad-based weakness across manufacturing, construction, and services, indicating a widespread lack of economic vitality. Second, the Bank of England's high interest rates, held at 5.25%, are a double-edged sword. While aimed at curbing inflation, they make borrowing prohibitively expensive. This chokes off business investment and sends mortgage costs soaring for homeowners, stifling both corporate expansion and the housing market. Third, despite high rates, inflation remains stubbornly persistent. Lingering at 3%, it stays above the official 2% target. This means the cost of living continues to squeeze households, as rising prices outpace wage growth, steadily eroding the real value of paychecks and savings. Fourth, this economic strain is hitting the job market. Unemployment is rising, now at 4.5%. This is a direct result of businesses facing weak demand and high costs. They are forced to pause hiring and make redundancies to stay afloat, creating a growing climate of job insecurity. And fifth, a mountain of public debt now stands at 100% of GDP, meaning the nation owes as much as it produces in a year. This immense burden severely restricts the government's fiscal firepower, limiting its ability to stimulate the economy through investment or tax cuts without risking market instability. Crucially, these forces don't act in isolation. They are locked in a dangerous feedback loop where each problem amplifies the others. Stagnant growth fuels job losses, while the cure for inflation, high rates, also chokes that growth. The result is a perfect storm that threatens to keep the UK economy stuck in low gear for the foreseeable future. The UK's economic predicament is clear in the data. GDP growth is nearly flat at 0.1%, a sharp contrast to previous recoveries. The Bank of England's 5.25% interest rate, meant to curb inflation, is squeezing borrowers and slowing activity. Inflation, at 3%, remains stubbornly above target, limiting the central bank's ability to cut rates. Unemployment has climbed to 4.5%, reflecting companies' hesitancy to hire or retain staff. Meanwhile, public debt at 100% of GDP restricts fiscal options. These indicators reveal an economy under pressure from all sides. The slowdown's impact is felt across every sector. Retailers face falling sales as households cut back, squeezed by high borrowing costs and persistent inflation. The housing market has cooled, with elevated mortgage rates putting homeownership out of reach for many and slowing construction. Business investment is stalling, as uncertainty and expensive credit deter expansion and innovation. Trade is subdued with weak domestic demand and post-Brexit frictions hampering both imports and exports. These pressures are driving up unemployment as companies freeze hiring or make cuts. The stagnation is not just in the numbers, it's reshaping daily life and business decisions across the UK. The data comes alive in real-world stories. A small coffee shop, once thriving, now faces falling footfall and rising costs, forcing the owner to cut hours and delay hiring. A young couple, priced out of homeownership by high mortgage rates, must keep renting as their savings lose value to inflation. A manufacturing firm cancels investment plans and lays off workers, squeezed by weak demand and expensive financing. These cases are not isolated. They reflect the broader struggles of UK households and businesses. Economic stagnation means postponed dreams, lost jobs, and shrinking opportunities. The urgency for effective policy action is clear. The human cost of stagnation is mounting, demanding a swift response. The risks facing the UK economy are real and growing. A deeper global slowdown could hit exports and tip the UK into recession. Persistent or resurgent inflation could force the Bank of England to keep rates high, prolonging the pain. High public debt limits the government's ability to respond with fiscal stimulus. These risks could reinforce each other, making recovery even harder. The margin for error is slim. Any shock could turn stagnation into a severe downturn. The UK is walking an economic tightrope with little room for missteps. To revive the UK's sluggish growth, policymakers face a monumental task. They must act decisively, navigating a complex economic landscape where every decision carries significant weight. The challenge is to stimulate activity without undoing the hard-won progress against inflation, a delicate balancing act that requires both courage and precision. On the monetary front, the Bank of England holds a key lever. A cautious lowering of interest rates could provide immediate relief, reducing the cost of borrowing for households and businesses alike. This would ease pressure on mortgage holders and encourage companies to invest in expansion. However, the specter of inflation looms large. After a period of painful price hikes, the bank must be vigilant, ensuring any stimulus doesn't pour fuel on inflationary embers. Clear communication will be paramount to guide market expectations and maintain stability. Meanwhile, the government must navigate its fiscal policy with immense care. Constrained by a high national debt and the watchful eyes of international markets, broad, unfunded spending is off the table. Instead, the focus must be on targeted, credible measures that deliver maximum impact. This means providing strategic tax relief for small and medium-sized enterprises, the engine of job creation in the UK. Furthermore, committing to long-term investment in critical infrastructure from upgrading digital networks to pioneering green energy projects can lay the groundwork for future productivity and competitiveness, creating a lasting economic legacy. Beyond immediate stimulus, deep-seated structural reforms are essential for long-term prosperity. This involves aggressively pursuing new trade deals to boost exports, opening up new markets for British goods and services in a post-Brexit world. Domestically, tackling the chronic housing shortage by streamlining planning and supporting the construction of affordable homes is not just a social necessity, but an economic one, unlocking labor mobility. To spur innovation, the government must create a stable and attractive environment for business investment, simplifying regulations, and using tools like R&D tax credits to encourage companies to invest in the UK's future. To ensure the recovery is inclusive, direct support for sectors still feeling the strain is vital. But more importantly, we must invest in our human capital. Proactive retraining and skills development programs are crucial to prevent long-term unemployment and equip the workforce for the jobs of tomorrow, in green technology, artificial intelligence, and advanced manufacturing. This is about future-proofing our workforce. Ultimately, there is no single silver bullet. A sustainable recovery demands a carefully calibrated and coordinated strategy, blending monetary, fiscal, and structural policies. The Bank of England and the government must work in concert, not at cross purposes, to build confidence among consumers, businesses, and investors. The choices made in the coming months will not just define the current economic cycle, they will shape the UK's trajectory for a generation. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.